economy has sort of decelerated from 8% to 5.4% in the September quarter, I mean, you can't get worse than that number. Essentially, the way we look at things is that India is still a relatively early cycle. Even if you look at things like government budgets, for example, we are not in a situation where government is going to breach their fiscal deficit targets. In fact, on the contrary, they've actually spent less capex than what they should have. So there's a lot of buffer that is there from a capex standpoint, from a government standpoint. Number two is private sector capex is yet to recover, and corporates are still flush with free cash flows. It is not that they don't have an ability to spend. And more importantly, we are still somewhere down the line at the peak of the rate cycle. So it's very, very typical that, if you have rates going up and staying higher, it has economic implications as well. So if you were to just put all these cyclical factors aside and look at how things will pan out, let's say in 3 quarters, you're going to see essentially economic cruise at the bottom for a quarter or two, and then it'll start to recover. So the only difference of opinion would be that the real bulls would say that, hey, we're going to go back to 8% growth in 2 years. I don't think that is likely. So what we're essentially saying is that 5.5%, if it is more close to bottom, you're probably going to be sliding back to 6.5% levels, which is very optimal for India, given that we do have levers. So that's like the path in which I see things shape up in the next couple of quarters.
Okay, what about banks? How are banks keeping up with what we are seeing on the deposit front? I believe that the credit deposit gap has narrowed, which is good news, but you're still seeing, deposit mobilization into equity markets, seeing more demat accounts, seeing more participation in the IPO market. So the rise of the domestic retail investor, do you think could be posing an existential threat to banks? Because they've had such a dream run, right? But at what point does the compounding effect slow down?
The way I would look at it is this. There are a couple of things which are more mathematical in nature out here. See, eventually money, wherever it goes, comes back to the banking system. So any investment avenues that you do are essentially more, those temporary impacts where you're essentially, instead of putting in fixed deposit, you're saying that, hey, I'm going to put something into an equity market. Now, eventually the money comes to the banking system in some form, right? It's only the flow and circularity which sort of tends to make you believe that that money is not available for, let's say, credit or for lending, right? And I think these things probably are only transition phases and sort of even out very quickly over time. So I'm not really too bothered about any structural risks per se, because as I mentioned, it's the same money which is flowing in, it eventually goes to a bank. The worry in the banking system per se was more about the credit risk that we were seeing, especially in the consumer buckets, which is where a lot of growth was coming through last year. And RBI has been a bit more careful with respect to scrutinizing these potential risks. And that's the reason a lot of checks and balances were in place, which is the reason where you saw credit growth sort of moderating for that area. And more importantly, credit from a point of view of industrial expansions is yet to pick up materially enough, to offset that to an extent. So these are cycle things. These are not structural issues in my view, any of these. So over the next 12 to 18 months, not even like 3 to 4 years, you're going to see a lot of these things iron out, and you'll start to see more order in terms of banking system or financial sector. So we do have overweight in financial sector at this juncture, but it's actually a smaller weight compared to what we used to have earlier, because we do believe that we need to increase weights over time through the year. But first half is probably not the right time to be deeply overweight financial sector.